Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining us today is Aryeh Landsberg, Managing Director at 17Capital. Ari, it's nice to meet you, at least virtually. How are you doing today?
Todd, thanks for having me. Doing well. Thank you.
All right. Well, let's jump right into it. Obviously, 17Capital is known for NAV financing. So tell us a little bit about, what is NAV financing used for in terms of is it used as a liquidity tool for GPs and LPs? Kind of how is NAV financing being used?
Yeah, absolutely. So I would say NAV is not just a liquidity tool, although that's often the goal for a GP to enhance liquidity, either in their fund or at their company. But really, we see the primary goal and use of NAV financing is to maximize flexibility and optionality. The applications and needs are really broad, and the industry has seen a lot of growth over the last decade. And at a high level, I would highlight that the most common use of proceeds we see are for GPs to invest more in their own businesses. So in a simple version, that's increasing commitments to their own funds, to their new funds, expanding into new strategies, either via seeding or by acquiring external teams or strategies. And it's also recently, we've seen an uptick in usage for succession planning, or to help support the next generation of partners participate in the fund's growth and the platform growth. And on the fund side, we see GPs using it to really think creatively and constructively about their optimized capital stack across their portfolios. So the general theme is really value creation. How are they able to most quickly and optimally get their fund deployed, thinking and taking into consideration the timing of their capital calls and the opportunity set in the market, and as quickly as they can deploying fully, which we find that LPs generally prefer to have their money put to work as quickly as possible. But I would, if I were to highlight the primary use, it's really accretive acquisitions and investments at the portfolio level. So a simple version is an add-on acquisition, a buy and build strategy where there's multiple M&A throughout the cycle of a company. And what we're able to do is really help optimize the financing costs and the equity stack for those investments. So there's really no end to the utilization and applications of NAV, but those are probably the primary applications we see.
Within those, kind of where would you say is the greatest opportunity? At least maybe that might differ in the next 12, 18 months to the next 5 years. Ultimately, where do you guys see the biggest opportunity in the space?
I think historically it has been for accretive acquisitions. We often liken it to a bit of an alternative to traditional M&A financing. And I think a lot of that's really driven by where funds are in their life cycle, where they are in their fundraising cycle, where they are in their deployment cycle. And so there's a massive opportunity, I think, to consider NAV as just one of many tools when deploying capital, when optimizing the value of their investment. So it's a difficult question to answer with full clarity, but I don't see a reason for that historical trend to change significantly in the future. But, and I'll caveat that with, we're in a unique and dynamic market environment. I know that's always the case, but it feels slightly more true now than in the past. And so uncertainty around distributions and decide and GPs making important decisions for their franchise about when to monetize and how to monetize. And we think NAV plays a really important part in ensuring that LPs get the most value out of the existing portfolios.
Now, I think an easier question to answer, which is, what are some of the biggest misconceptions about NAV loans, and ultimately, how do you guys help, bring a better understanding as to use of proceeds, and where the media has clearly taken up some of these smaller use cases, but it has, certainly brought a lot of questions coming to, I'm sure, the likes of 17 and many others.
Oh, absolutely. And I think the good news for those of us who provide NAV loans and for the GPs as well who are considering it and have been deploying NAV loans for throughout their history is that the market and the adoption rate has really increased organically over the last 5 or 6 years. And I think the inflection point was probably in early and mid 2020, given the market disruption at that time. So some of the perception that we think still persists is that there is um, there is a often a perception that NAV is primarily used for LP distributions or synthetic distributions back to LPs. We really don't see that across our existing portfolio, either currently or historically, or in our pipeline of new transaction flow. Um, in our internal analysis as well as our market surveillance, we see that it's small single digits of the overall NAV application, and the vast majority, over 90%, has been for money in to the portfolio. So that's investment in portfolio companies and investments. So there is, I think, this persistent perhaps misunderstanding of what the product really is at its root. We actually very recently published a white paper breaking down our own internal statistics and kind of highlighting what our experience has been. But this has really been consistent across the industry. So that's certainly one of the misperceptions. I'd also say, particularly with the narrative recently, that private equity has seen a slowdown in distributions overall. We've had a number of conversations really to address the concerns that potentially this would cause NAV loans to have delayed exits or prolonged lives. And we certainly haven't seen that at all. And I think it's really because the products themselves require a lot of analysis. We at 17Capital focus strictly on partnering with the strongest managers with strong and performing portfolios. And so our underwriting and structuring process really helps ensure that we are senior in that process, that we're getting out, before there's any potential for risk, for risk or credit declines. And we've actually seen a lot of momentum for some of our transactions to exit in the last year. We've had several already in 2025 that are operating exactly as you'd expect. So despite some of the headline that private equity and sponsor-backed companies have been slower to realize, we are certainly seeing that under the surface, there have been a lot of exits, and that our credit book is performing exactly as we'd hoped it would.
A little bit more about 17 Capital now. How does it differ from when the firm started to where we are today, and kind of who are the core borrowers that you're targeting?
Sure. So a lot has changed, I think, since 17Capital started. Ironically, 17Capital is in its 17th year, so you're catching us at a good time. But we like to say that in a lot of ways we were early pioneers of the NAV market. So there's certainly been an evolution, I think, of the use case, the borrower case, since the beginning days as the product has really gained more mainstream adoption. I'd say the majority of that innovation and adoption has been at the top tier. So the blue chip managers, I think that probably a decade plus ago were either unaware or not particularly interested in utilizing NAV, or are almost inclusively considering it or have deployed it for their flagship strategies and for their other strategies outside of private equity. And
Does
so,
that help?
yeah,
Like, did that help, and does that help kind of get maybe the second or third, or I don't want to call them tier managers, but ones that are not to the size and scale of those quote unquote blue chip names? Does it help that they're using it? Then it gets the other ones more comfortable with it. Well, if this X fund that's top two or three in the world is using it, then we should feel comfortable enough. This is a product we might be able to utilize.
that's a really good point. I think where it most acutely is, the way it's most acutely felt is that the top tier managers, the mega caps, the largest fundraised vehicles in the market are also some of the most widely invested by the most institutional LPs. So there is a familiarity, a sense of trust, and also a sense of successful deployment that I think the investor base can gain from that exposure. So it helps on that regard. I also do think it helps not to be reductive, but for some of the smaller managers to say, as they're speaking with their LPs about the potential to use NAV loans for an acute investment need or for a specific use case, they can point to the fact that a significant part of their own LP base has seen it before and has enjoyed it, and not that there's a sense of missing out, but there's a sense of we've seen this before, it's worked well. Um, and I think maybe most crucially, and I don't want to forget the chance to highlight this, what we see and what we've noted from the market is that what drives a lot of this adoption is competition. And
Mhm.
not just competition for feeling left out, but competition for strongest returns in your peer group against your
Yep.
benchmark. And so when the strongest, largest, and best performers use it and it works out and it's a successful application for them, I think it's something to consider. I think that other managers tend to view that in the right perspective, which is if it's really giving a competitive advantage to firms and we're not using it, does that put us at a disadvantage? And again, every situation varies, so there's no blanket statement on that. But I think the fact that the vast majority of NAV transactions have been directly accretive to IRR and to LP returns. And that's probably a real catalyst for adoption going forward.
Now, in terms of borrowers, is it solely private equity funds?
Mhm.
What about credit funds? I know initially, I think early on, you guys had lent to LPs. Are you still doing that? Kind of what does your borrower base look like, and how is that evolving?
So at 17 Capital, we are primarily focused on private equity and buyout in North America and in Europe. That said, the market for credit financing is massive. It's a very competitive market now. We see a lot of entrants into that market, and I think due partially to cost of capital, but also competitive dynamics, it can be competitive from a return perspective as well. Uh, I would also highlight uh, the entry of secondaries managers into that space, which has put some uh, which is help from a borrower perspective to create a more competitive opportunity set
Mhm.
for them. So it is something we're aware of. We are always open to the right risk reward opportunities, but when we speak to our own investors and describe our expertise, it's historically been private equity, that those are our roots. And you're absolutely right to highlight our roots going back to 2008 were around LP liquidity solutions, helping LPs increase their own exposure to private equity or to get liquidity back. That is certainly an active part of our overall investment mandate. Um, we work a lot with family offices and with large institutional LPs around optimizing their own investment into private equity. So I would say it will continue to be part of our overall allocation, but the bulk of our deployment in private equity is really towards the buyout managers and their funds at this stage of our elevation.
I saw either I read or I heard a stat saying 95% of GPs now utilize a fund finance product in some form or another. I mean, what are some of the biggest drivers? Is it because fundraising and distributions have become tougher and it's it helps to that? You mentioned obviously if you look at returns, It's helped returns
Mm.
as well. What's kind of behind this? From my perspective, at least, the last couple of years, it's just seeming like it's just like through the roof. You can't get it through a day or a week without hearing something on fund finance, generally speaking.
Yeah, I agree, and I would suspect that that statistic is likely including some other things other than NAV financing, such as subscription financing
Yeah,
or interest
it
rate
was
hedging.
inclusive. Yeah,
Yeah,
exactly. It was inclusive of everything, but it just
sure.
seems like the fund finance market has just exploded.
I agree. We saw this and we liken it to our experience in NAV, not to make it not to make it all about us, but I do think that there are significant parallels with the adoption of subscription financing 20 years ago to where other types of supportive fund finance have become more commonplace. And much as we saw subscription finance become almost ubiquitous across the private equity and alternative closed-end fund universe, we think that NAV will follow suit, although it's at a significantly delayed adoption rate. And it's because it enhances the LP investment process experience and the return profiles. It helps the same way that subscription financing really helps LPs manage their cash balances and not have frequent capital calls and frequent interaction uh, with their investor base, which for the largest institutions can run hundreds of line items. The
Yeah.
subscription finance really narrows it down to a once or twice a quarter required cash flow engagement. We think fund finance, to the extent it includes NAV finance, really does the same for GPs managing their own investment processes. They can deploy quickly. They can deploy when they don't have a subscription line, at the ready, and it allows them to optimize their capital stack across the company and across the fund. So I think we'll continue to see the uptick in fund finance. I would imagine that yeah, that 95% is a pretty good adoption rate. Um, but our own projections are, at least on the NAV finance front, we expect continued parabolic adoption. And a lot of that's been led by the mega caps, but we're seeing a lot of first time users come in. And what I think is crucial is we're also seeing a significant number of return users. So managers that have used one or two NAV lines that are going back for their third, and it's becoming a serial issuance for them. So I think that that probably feeds into that statistic as well.
If I'm a new manager, um, maybe I've used the subline to manage those cap calls. Um, what would where does the NAV financing come in my evolution? What we've certainly heard is that there's a somewhat of an education gap, maybe even among more the younger or earlier funds. They haven't, deployed three, fund four, whatever. Is there an education gap, and where would you say is kind of the NAV financing, NAV loans slot in to an evolution of the fund?
Again, it's tough to provide a blanket statement on that because the use and the ideal application for the financing changes for each situation. But I'd say the generic example to highlight would be a, a fund that is on its third or fourth vintage. They're raising perhaps their next vintage, so vintage five. They have a long track record. All of the previous vintages have shown increased size and strong performance. And for in that example, vintage three or four is through its investment period. They've called all the capital and they have attractive investments to continue to make in their portfolios, either through synergistic mergers or through debt refinances prior to sale. Really, it's tough to summarize all of the uses, but that's probably the optimal and ideal point for them to think about NAV. Um, that said, we see a lot of inbounds in the market from earlier managers, some of which with very strong pedigrees, spin-offs from larger managers. Um, it's not likely that that's the place where 17 Capital focuses. We have a strong bias towards managers with long track records and long histories of performance. But the NAV ecosystem is expanding. There are a lot of providers, and there are those that'll focus on smaller managers, newer managers, and we think that there are certainly use cases for them as well, particularly as they're gaining traction and out on the road fundraising and have some strong early performance to show. Uh, NAV is a all-weather product, and I would imagine that we'll see the growth in that sector of the market as well.
So I have ILPA was on the podcast recently. Their episode is actually coming out today when we're recording. And we had talked through, obviously they represent LPs. We talked through the LP view on NAV financing. They've put out some guidance. How do you work with GPs, LPs to kind of level up what is known about NAV financing and how to kind of maybe combat some of their negative feelings, which today, to be clear, is still pretty negative, generally speaking, at least according to ILPA's polling. How do you combat some of that, and how do you work with the LPs and GPs to kind of give more transparent insight into some of the stuff you've been talking about here today?
Yeah, that's the way I would describe our experience and reaction to the ILPA guidelines is that we've been engaged and partnered with ILPA throughout the publication of their guidance. We think that their guidelines really helped codify the best way to communicate NAV deployment. So we're very much in alignment with the ILPA guidelines. We found them to be very helpful in our conversations with potential LPs, with managers when we're speaking with them. It's often a question that we get when we're engaging with managers is how are LPs going to react? How have other borrowers' LP bases reacted? And we think that in the simplest form, transparency and specificity around the deployment is key. And when GPs are transparent about what they're doing, how they're doing it, why they're doing it, particularly in the context of what their alternatives are for a particular use, it's a very compelling argument, or at least a very compelling option for them to deploy. And that's really how I think about it. And I think that's how most of the industry thinks about it, which is NAV is just one item, one tool in the toolbox. And when LPs are presented with the alternatives, and the NAV alternative is either the strongest or the most cost-effective or the most efficient or the most flexible option, they're likely to be supportive. If it's not, then that's where I think you can hear some of this negative feedback. So our view is that if an LP feels strongly that they aren't comfortable with NAV loans being in their portfolio or being used for a specific case, then the GPs shouldn't do it. We're certainly not incentivized to spend a lot of time working on a transaction that's negatively received by LPs, or that goes against the experience of the LP base. It won't be a good experience for the GP as well, and it won't be great for their relationship with their own investors. So I think the entire industry is aligned on that point. But I would say that to our earlier conversation about some of the misperceptions, there seems to be a nagging belief that this is really being used to enhance distributions and to put leverage on the rest of the portfolio to get money out inorganically. We think of it a bit as a synthetic DPI transaction. And it's just not the area of the market where we're active. We just don't see it a lot. What we do see is NAV financing used as a flexible, lower risk, and more transparent use of financing versus some of the alternatives, such as portfolio company dividend recaps. We have this conversation a lot, particularly with managers who are often prioritizing early distributions from their portfolios and have historically done so by portfolio company dividends. So taking out debt at the portfolio company and sending that back, and de-risking a portfolio on a single line item basis. And when we have these conversations, I think it's a fairly it can be, particularly in the wrong scenario, an aggressive way to do that. It adds portfolio company debt. It can make it harder to sell. It reduces the aggregate equity, and a portfolio level financing doesn't add any incremental portfolio company debt. When the fund is the borrower, it's not hitting the balance sheet of the company. So LPs are certainly used to div recaps at a portfolio company level. I do think over time there will be an adoption where DPI and distributions back to LPs are driven by fund level NAV. It's really not a large part of the market today. That said, I think there's some merit to the fact that distributions have been slow for a longer period than expected. The consensus was 2025 was going to see a boom of IPOs, of sponsor-driven M&A, and that certainly hasn't happened through this May. Although there's certainly been some headline transactions. So I would imagine that we'll see not just GPs considering some of those types of applications for NAV, but also some LPs saying, I have other commitments I've made to other strategies. It'd be nice to get some liquidity as an alternative to a secondary sale or some other form of monetization. We'll probably see inbounds for those. But through the first half of 2025, we really have not seen that use develop.
I mean, in some ways, it's just an evolution of the market. I mean, it starts here and it shifts and evolves over time. And, that can be a bigger part of the market in 5 years from now. But, I think the misnomers around it is that it's utilized for this use case that the media and others have kind of picked up on. And the numbers clearly show it's not.
Yeah, and I would also highlight, and I think that's exactly right. That's a very efficient way of saying what I think I'm trying to say. But I would note that there are certainly applications where I do think it makes sense, and we as a firm think it makes sense. A clean example is a manager that has agreed to sell a company. So it's already a sale process has been executed, but the time to closing or to monetization may be prolonged due to regulatory holdbacks, due to a deferred payment. And so they know the value they're going to extract out of a company. It's been codified, it's been executed, but they may have to wait a year or 18 months until they actually receive it. I think that type of bridge financing, as long as the economics make sense, are an ideal utilization for a distribution LP backed by a NAV loan. To redeploy for the LP to redeploy the capital more efficiently as opposed to just waiting.
Yep. So we're in a certainly a higher rate environment than any of us has seen for quite a while. Have you seen higher for longer impact borrowers? Have you seen deal activity, evolve recently because of higher for longer?
We have not, and I think that the primary reason, if I think about this in a longer term, more holistic perspective, is that rates are high compared to most of our recent experience, but they're not historically high. If you expand the Fed funds rate out, another decade or two, we're still in the bottom right. And so I think until we see a material slowdown overall to structured product issuance, to leverage finance issuance, we're unlikely to see a real change in the dynamics of the NAV loan market. That said, we absolutely see a correlation when there is disruption in the syndicated bank loan market or in private placement markets, and that's, I think, just the natural ancillary of NAV being an alternative form of funding. So, for example, in 2022, when I think there was a real slowdown in bank-led sponsor-backed loan issuance, we saw impact in the pricing and the terms for NAV loans. We haven't seen compression yet or a slowdown in the pipeline for sponsors looking for NAV because of the overall all-in financing costs. And I think that's because on a competitive basis across other forms of financing, it's not really pricing at a premium at this point. So it's a competitive and alternative to other forms of financing, whether they be debt or equity.
Speaking of competition, have you started to see whether it be deal terms, spreads, fundamentals evolve recently, given the um, increased competitive nature, other funds getting into the business? What has kind of the competitive landscape started to do, or has it even started to kind of change deals that maybe 2 years ago looked like version A and now they look like version C?
It's a very interesting time to be in the market as an NAV loan provider. So perhaps some context is helpful to explain how I see our position in the market. Given 17Capital's size and scale at this point in our life, we tend to focus on the top tier blue chip managers with larger funds that are often looking for larger size NAV loans. So there's an interesting dynamic that we see, particularly with competition at the lower end of the market. And by lower end, I don't in any way mean to talk about quality. I'm talking about the size.
Yeah.
So a NAV loan, for example, a NAV loan of $100 million will see a far greater amount of competition. Simply put, there are a lot of firms out there that are participating in 50 to $100 million NAV loans. And what you can see is those can often be auction processes. There can be spread compression or a search for the lowest common denominator on terms, particularly when the sponsor is driven primarily by price. There are often other considerations, flexibility and terms. But candidly, that's not the part of the market where we spend most of our time. We tend to focus on larger managers looking for larger loans, where there's actually fewer lenders looking to participate, to be able to speak with full confidence of execution and be able to write checks that large and have a track record. I think that gives confidence that they can execute. And so what we see is what we feel is a pretty attractive risk return, given that you're looking at larger companies, stronger fundamentals, larger EBITDA, and also a variety of exit opportunities. Some of them are large enough in scale that they are merger partners for large publicly traded corporates. They may be IPO candidates themselves. They may have the ability to do debt recaps to refinance the NAV loan down the line. They have a lot of ways that we as the lender can get comfortable that we'll see return of capital. I think those options exist somewhat further down the scale, but at the bottom end, it's generally a sponsor or a strategic exit, and again, particularly if you're in a niche market, that can limit your exit opportunities. So we like the area we're in. We are certainly interested in what smaller and what scaling managers are doing. But more and more we find ourselves migrating towards the upper middle market, lower mega cap, and largest funds.
We have just a few minutes left here, so I'd like to end a little bit lighter. So do you have a favorite sports team and/or hobby?
It's good timing. The NFL schedule just came out a few days ago, so I was born and raised in Baltimore, Maryland, so I am a big Baltimore Ravens fan. We're opening up the season at the Bills, so I'm feeling
which is my team. So
feeling a little nervous about that rematch after the playoffs. But I'm also an Orioles fan, so in the summer I get to spend my time watching that team historically let me down. But
well, one thing we have in common is we both can't get past the Chiefs for some reason. So
whenever Mahomes decides to hang it up, I think we'll have a shot.
Tell us one surprising thing about yourself.
Well, I have 10-year-old twins. So when I'm not doing this, I'm kept fairly busy chasing them around and ushering them to their busy schedules.
One book that you would recommend reading.
There's a book called Pappy Land by Wright Thompson. Wright Thompson's a fairly well-known sports
Yeah, I'm familiar with
writer.
him.
Yeah, he's great, done a lot of profiles, but it's a really good book about the American South, but also uh, the way effective marketing makes us nostalgic to connect with our past.
Hmm.
It's a really good book. I had trouble putting it down. I wish I could reread it, but highly recommend.
Most exciting part of your job.
I like solving problems for our clients first and foremost, but what I find particularly rewarding over the last couple of years has been to support the growth of our junior team. There's a really strong bench in the industry. I think they're gonna really put us to shame with how they were able to put the industry shape it going forward. And so I think we're gonna be in a really good position when guys like you and I are retired. The youngsters are gonna do a lot of good work.
And then final question, one prediction for the next 12 months.
Ooh. Um, well, I am a reformed equity trader from my youth, so when I look at when I look at public markets, I tend to think they've gotten a little sanguine and complacent to some of the headline risks. So maybe it's not a hot take, but my prediction is that we're in for a lot of volatility in the public equity markets, and we're going to continue to see pretty sharp moves both up and down as we work our way through some of the macro headwinds. The good news is NAV alternative credit is really well positioned to ride through those periods. It's a great time to deploy. So we are excited to help our clients have competitive advantages and have readily available capital in what I think is shaping up to be a stressful time for those in the public markets.
Well, Ari, I really appreciate you taking out some time and chatting with me. So thank you. And continued success to you and the team at 17Capital. We'll catch up again sometime in the future.
Sounds good. Thank you so much for having me, Todd.
Yep, of course. Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.